Hi, and welcome to the Mint Funds monthly market update for the diversified funds. My name is Alistair Dring, the Assistant Portfolio Manager here at Mint Asset Management. We're covering off the month of July. Please take a moment to note the disclaimer. Great, let's get stuck in. The market risk model, which is a three-tiered orthogonal signal model that we use to give us a health check on financial markets, having quite a broad spectrum. And it's used to inform a view around where risk is positioned from a sentiment, but as well as sort of structural and from a cyclical perspective. And over the month of July, we had seen a marked move towards defensive positioning. We use this to, have a conversation. It forms a part of our IC chats and how we look to change the dynamic asset allocation of the funds. And the point readings are as important as the rate of change. So given we moved from something that was largely cautious and neutral, and we had a buffer of around 0.8, that was half of that was taken up by the change over the course of the month. That was in our short-term signals as well as our medium terms, which is more business cycle focused. Our structural long-term signals haven't changed. Naturally, they're a bit slower moving. We've got the short-term signals, which do bring in a bit of noise, but we've weighted them accordingly to ensure that the noise doesn't outweigh anything of meaning. But it's always worth hearing what the noise is, but being able to distill that into something that's useful. We're going to bring this up at the start of all of our videos, just to give you an indication of what we're seeing and looking at. And the direction that we have seen over the last month is towards a more defensive stance. Reason being, the month in terms of market outcomes was largely sort of risk off. There was a sort of negative performance quite broadly, particularly developed market indices. But if you look at developed market ex-US, 1.5% positive return. On the other end of the spectrum, you've got emerging markets suffering quite considerably, and then everything in between. But you've also got, underperformance or negative performance from rate sensitive assets, and we'll go into a little bit why that has taken place and what's caused these headline figures. So I think it's interesting to look at the month and sort of a journey, and it is. You need to sort of tick the boxes off as you go. The geopolitical risks reared their ugly head again through the month of July. This is not new news. I think we were all anticipating, or at least concerned that this would happen again, but it's what the knock-on effects of that are. And given the central banks were all taking meetings in their various capacities in the month of July, this had a marked impact on fixed income assets. So with inflation as a second order effect of the geopolitical risks, and central banks meeting and looking to challenge that and bring that inflation within their target bands, we had saw yield curve shifts quite considerably over the month. But the RBNZ met around the 8th of July, and they were stating that we need to hike rates, and took their the OCR up to 2.5%, given that headline inflation was outside of the target bands of 3%, as you can see in the chart on the right. That was in March. Now, their meeting in July was in order to manage that and bring that in line. Now, the June reading as well was significantly above band, but that was the imported inflation component of the previous oil price shock as a result of the conflict. We saw a few days after the RBNZ met that conflict spiked again, and the US-Iran strikes resumed. Brent crude shot to over 105 over the month, and I think you can almost look at that Brent crude price and then infer, well, what's the inflation impact further down? And I think in this next slide, looking at what the RBNZ has to challenge in terms of the inflation piece is what they're forecasting, how they're going to use monetary policy to challenge the inflation aspect from the forecasting, but whether their forecasting is any good and what's happened. So I guess looking at what they forecasted in March for June was a inflation of around 3.9%. That came in at 4.1. What they forecast for September is 3.3%, and I anticipate that we will see this current bout of shocks come through in that reading, and anticipate to see what that looks like, because it'll be an important reading for monetary policy, yields, as well as the growth outlook for equities as well, locally. Interestingly, in the US, this was quite a varied change, with a best deepening in their yield curves, but with the 30-year yield rising significantly over the course of the month to yields that haven't been seen since 2007. But you've got a really strong equity market underlying that, but naturally fixed income investors, given that they don't have the upside potential that equity investors do, are naturally more pessimistic. And with a Federal Reserve that chose to keep rates as they were, but with some more sort of hawkish, a dovish sort of positioning or language used, fixed income investors say, well, if you're not looking to challenge and try and constrain this inflation right now through monetary policy, that's going to impact us further on in terms of economic growth. We'll want a higher premium for any sort of lending down the track, hence why yields have risen quite considerably further down in the longer term. Now, once yields start to shift into, sort of the latter part of the curve, a lot of that starts to look a little and feel a little bit more structural than being managed in the short term. So that is something to watch, is how that yield curve shifts over time. The comfort is looking at how the high yield spreads haven't blown out, which shows that there's strength still within the equities. Their earnings are strong and positive, and we'll go into a little bit more detail there. So this to us was more of a duration event as a result of inflation, and not really a risk-off event or a risk event through the month. Naturally, if you looked at the semiconductors alone, you would probably argue otherwise, but they have forecast their earnings up quite considerably, and now those are being discounted at a much higher rate, therefore re-rating them in the present value terms. Looking at the difference between the S&P equal weight, which is largely a value index now, versus, let's say, the NASDAQ, which is growth, you see quite a dispersion between value and growth. So you're seeing investors shift portfolios to things that are slightly more defensive, that don't fully embed themselves in this semiconductor AI capex build out, because that's starting to sort of have a few concerns or a few question marks around it. So the bottom row that we're looking at there is some of the signals from the tool, is looking at, well, the constituents of the S&P 500 as a broad index looks relatively flat, although down slightly over the month, but 59% of the index was positive. Then looking at the dispersion between value versus growth, i.e. equal weight versus NASDAQ, the widest it's been since 2003. So you're seeing a bit of dispersion there in terms of where returns are coming from, which is encouraging considering we've had equity market run that's been highly concentrated. Yield curve from spreads in credit names widening, but not stress, something to watch for us. But the breadth as well has been encouraging to see close to 70% of the market, S&P that is, those particular names above the 200-day moving average, indicating that a lot of participation and a lot of strength still there. That's why we're not too concerned about the yield curve, the spreads in high yield or investment grade, but the yield curve is concerning for the fixed income market. So a lot of the performance has come from that duration piece. Is the equity, our equity returns been forecast so far out that they're now impacted by the duration, higher duration earnings being impacted by high yield, discounted back, or are they particular names that benefit from rate changes, i.e. financials? So strong performance coming from financials, stronger performance coming from more defensive cyclicals in the way of pharmaceuticals, Some industrials that are unlinked to the commodity exposure performed well, and naturally property, given its duration, performed poorly. And there are some sort of idiosyncratic names locally that did perform quite well. So global equities were positive for us, given our weighting to defensive names, mostly financials and pharmaceuticals, at least versus the index. We did still have some exposure to the sort of the hyperscaler play. Naturally, their weighting in any index warrants having some inclusion, and given their performance as of late. So that's just a bit of flavor around where performance has come across the board from a rates perspective, a AI capex rotation, as well as the defensive cyclical repositioning. Diversified income fund, given its weight to fixed income in the portfolio, was down around 0.5%. The fixed income piece itself down around 70 basis points. That was offset by stronger performance of global equities and our, the stated positioning that we had, financials, healthcare, but a local idiosyncratic performance, particularly in New Zealand. And again, rates locally were raised by not only the OCR, but across the board wholesale rates were up, and that was a drag on any fixed income names we had, as well as the property exposure, given its duration sensitivity. The growth fund, this, because of the weights of the hyperscaler names within the portfolio, as well as in the index, were a big drag on the performance, but we were able to eke out around 20 basis points of positive return through our weighting to more defensive names within the portfolio, which was encouraging to see, although not enough to offset that large negative from the duration change, which not only was in the fixed income market, but in quite a few of duration sensitive equity names. Relative to peers, we performed quite well. We held up strongly in the cohort, and felt we were positioned quite successfully for this particular month. Yeah, back onto the 3x3 model. We'll use that in future to inform the view going forward. And I just wanted to touch on an email you might have received on the 3rd of August, just indicating that the fund names are going to be changing. The income fund is now being called the Mint Conservative Fund. Its income name is falling away, as well as the distributions are falling away as a sort of a mechanic to be paid out. But we have a system in place where we can set you up with a sort of a self-dividend, as it were, with a quick form. We can help you through that process, relatively straightforward, and we can get you set up in a way that you would not even have noticed that there was any change other than the name. The Mint Diversified Growth has just been changed to the Mint Growth Fund. If you've got any questions around that or anything else in the presentation, please let us know. Details are on the screen now, and we'll see you next month. Thanks. Bye.